Most investors believe the future is something you have to predict, that if you don't know where rates are going, where technology is headed, or what the next cycle looks like, you're already behind. But there's a quiet paradox hiding in plain sight. The most successful long-term investor in modern history built his entire system around not knowing the future. No forecasts, no macro calls, no dependency on being right about tomorrow. Just structures that survive uncertainty and compound through it. And that paradox is the real lesson. And this is Dark Alpha, where value meets velocity. Right now, prediction is selling at a premium. Markets are saturated with forecasts, AI-driven models projecting earnings 10 years out, macro influencers calling the next recession, the next boom, the next collapse. Entire portfolios positioned on scenarios that must be right to work. And here's the uncomfortable truth. The more complex the world becomes, the more fragile prediction gets. Technology accelerates feedback loops. Capital moves faster than models can adjust. Geopolitics injects discontinuities no spreadsheet can price cleanly. For investors, founders, and capital allocators, the cost of being wrong has never been higher. Leverage amplifies errors. Narratives harden positions, and conviction without margin for error becomes a liability. So the real risk today isn't missing the next big thing. It's building a system that collapses if your assumptions break. This matters because most people don't lose money slowly. They lose it when a hidden dependency snaps, when a forecast fails, when liquidity disappears, when timing, something they thought they controlled, turns against them. Understanding why Warren Buffett doesn't need to predict the future isn't about copying his stock picks. It's about recognizing a deeper operating system for capital, one that treats uncertainty not as a threat to eliminate, but as a condition to design around. If you don't understand that system, you're not just missing an idea. You're exposed to a structural weakness you can't see yet. Let's strip away the mythology. Warren Buffett is often framed as a value investor with an uncanny ability to see what others miss. Someone with extraordinary judgment about the future of companies, industries, and markets. That framing is comforting because it implies success comes from superior foresight. But it's also misleading. Buffett's actual edge doesn't sit in prediction. It sits in construction. Specifically, how capital is positioned, funded, timed, and insulated from error. Buffett operates in a world where the future is fundamentally unknowable, not hard to predict, not temporarily unclear, unknowable. He's said versions of this for decades, often casually, almost dismissively. The future doesn't need to be predicted if your downside is protected and your upside compounds. That idea sounds simple, but its implications are radical. Most market participants reverse the logic. They start with a view of the future, then they build portfolios to exploit that view. Buffett does the opposite. He builds capital structures that work across many futures, and he lets time do the heavy lifting. To understand why this matters, you have to recognize what prediction actually does to decision-making. Prediction narrows your range of acceptable outcomes. It concentrates risk around a story. It rewards short-term correctness over long-term durability. And most importantly, it creates hidden fragility. When capital is dependent on a specific future, volatility stops being noise and starts being existential. Buffett's system removes that dependency, not by avoiding uncertainty, but by embedding it into the design. This is where most surface-level explanations fall apart. They talk about patience, temperament, discipline. Those traits matter, but they're downstream. Upstream is architecture, insurance float, permanent capital, decentralized operating companies, minimal leverage at the holding level, cash not as a drag, but as an option. These aren't personality traits, they're structural choices. And those choices create a strange outcome. Buffett can afford to be wrong about the future far more often than most investors, because his system doesn't demand precision. It demands resilience. This episode isn't about idolizing Buffett, and it's not about dismissing forecasting altogether. It's about understanding a deeper truth that's becoming more relevant as the world accelerates. In complex systems, the highest performing strategies are often the ones least dependent on being right, and Buffett's entire empire is built on that premise. The first core idea is this: Buffett doesn't invest in companies. He invests in systems that absorb uncertainty. That distinction changes everything. When most investors analyze a business, they focus on projections, revenue growth, margins, market size, competitive threats 5 or 10 years out. Buffett looks at something else first: cash behavior, durability of demand, pricing power under stress, and, most critically, what happens when things don't go as planned. Take insurance. From the outside, insurance looks boring, low growth, regulated, capital intensive. From Buffett's perspective, insurance is a financial engine that converts uncertainty into advantage. Insurance generates float, money paid today for claims that may not be paid for years, if ever. That float isn't free, but when underwritten correctly, it's cheap, and when scaled responsibly, it's stable. Here's the key: float gives Buffett long-duration capital without fixed repayment schedules. No margin calls, no redemptions, no forced selling. That alone eliminates one of the biggest killers in investing: timing risk. If markets crash tomorrow, Buffett doesn't need to predict when they recover. He doesn't need liquidity from the market. He is liquidity. Now zoom out. Berkshire Hathaway isn't one business. It's a federation of cash-generating operations across unrelated industries: railroads, utilities, consumer brands, industrial manufacturing. These businesses don't move in sync. They don't rely on the same macro variables. They don't all break at once. This is not diversification for optics. It's diversification for survivability. The system is designed so that no single future dominates outcomes. Here's the reframing moment. Buffett's genius isn't that he knows which businesses will win. It's that he avoids businesses where losing is catastrophic. That sounds obvious. It's not. Most capital chases convex upside without respecting convex downside. Buffett flips the asymmetry. He seeks businesses where downside is limited by structure, behavior, or necessity, and upside is unlocked by time. Think about Coca-Cola. Did Buffett predict global sugar consumption trends decades out? Did he forecast branding resilience in emerging markets with precision? No. He recognized something simpler. People drink beverages in good times and bad. Brand loyalty reduces price sensitivity. Distribution creates barriers that don't show up in spreadsheets. He didn't need to know how fast Coke would grow. He needed to know it wouldn't disappear. That's the elimination of prediction. Another example: capital allocation inside Berkshire. Subsidiaries send cash to headquarters. Headquarters reallocates it where expected returns are highest at the moment. No commitment to a single strategy. No rigid capital plans locked years in advance. This is optionality in motion. When opportunities are scarce, cash accumulates. When panic hits, cash deploys. Buffett doesn't predict crashes. He prepares for them. There's a difference. Prediction requires confidence in timing. Preparation requires humility about ignorance. Now consider leverage. Buffett is often criticized for being under-levered, for leaving returns on the table. But leverage is a prediction amplifier. It turns small errors into terminal ones. By keeping leverage low at the holding company level, Buffett ensures that volatility doesn't force action. He can wait. He can do nothing. Doing nothing is underrated. In markets, inactivity is often framed as indecision. In reality, it's a privilege reserved for those whose systems can tolerate delay. Buffett's can. And that brings us to the deepest layer: time. Buffett's system is explicitly designed to compound over decades, not quarters, not election cycles. Time smooths randomness. Time rewards businesses that generate excess cash and reinvest intelligently, but only if you survive long enough to let it work. Prediction-focused strategies often fail not because they're wrong, but because they're early. Buffett removes that risk by refusing to depend on precise timing. The system doesn't ask, "What will happen next?" It asks, "What continues to work even if I'm wrong?" That's the first core argument. Buffett never needs to predict the future, because his capital structures are built to endure multiple futures without breaking. Now, let's introduce the counterweight. Because there is another philosophy of capital that dominates the modern era, one that embraces prediction, acceleration, and concentrated bets. And the cleanest contrast is Warren Buffett versus Elon Musk, not as people, but as systems. Musk's approach is built on aggressive forecasting, technological roadmaps, exponential curves, winner-take-all outcomes. Capital is deployed ahead of certainty. Losses are tolerated early. Risk is embraced explicitly. This model can create enormous value, but it's fragile in a different way. Musk's system requires the future to arrive on schedule, or close enough. Delays matter. Capital markets matters. Narrative confidence matters. In other words, prediction is embedded into the structure. Buffett's system rejects that dependency. Where Musk compresses time, Buffett stretches it. Where Musk leverages belief, Buffett leverages cash flow. Where Musk builds for dominance, Buffett builds for durability. Neither is inherently superior. They serve different economic functions. But the trade-offs are real. Prediction-based systems concentrate upside and risk. They reward being right early. They punish delays and deviations. Resilience-based systems cap upside, but reduce the probability of ruin. Here's where many people get confused. They think Buffett avoids technology because he doesn't understand it. That's not accurate. He avoids businesses where the future path matters too much. In tech, small shifts in standards, platforms, or consumer behavior can erase moats quickly. That doesn't mean tech is bad. It means prediction risk is higher. Musk accepts that risk. Buffett prices it out. Another trade-off: capital recycling speed. Musk reinvests aggressively into growth. Cash is fuel. Idle cash is inefficiency. Buffett treats cash as latent optionality, a strategic reserve. One system maximizes momentum. The other maximizes endurance. The modern market environment tends to celebrate the former because it's visible, because it's exciting, because it produces dramatic narratives. Buffett's system is quieter, slower, harder to replicate, and less dependent on belief. Belief is powerful, but it's also volatile. When belief breaks, prediction-based systems can unwind quickly. Buffett's doesn't rely on belief. It relies on cash flows continuing to exist. That's a lower bar. So the real contrast isn't old versus new. It's prediction versus design. One asks, what future do I believe in? The other asks, what survives regardless? Understanding this distinction is critical, because many investors unknowingly mix the two. They use leverage and forecasts like Musk, but expect stability like Buffett. That mismatch is where damage happens. If Buffett's model works, and history suggests it does, the implications are broader than one investor's success. First, capital allocation shifts from speed to durability. Money flows toward businesses that generate excess cash under a wide range of conditions, not just during booms, not just under ideal assumptions. This favors boring excellence over flashy growth. Second, time becomes a strategic asset again. In a world obsessed with immediacy, systems that reward patience gain relative advantage, not because patience is virtuous, but because it filters noise from signal. Third, volatility becomes opportunity instead of threat. When you don't need to predict the future, dislocation isn't frightening. It's informative. Prices tell you where stress exists. Cash lets you act without urgency. Now flip the scenario. If this model fails, if durability stops mattering, the consequences are stark. Markets become arenas of narrative dominance. Capital chases stories faster than fundamentals can validate them. Leverage becomes the norm, not the exception. In that world, small shocks cascade. Liquidity dries up faster. Failures propagate. Those who benefit are the fast, the leveraged, the early. Those who pay the price are the late, the patient, the conservative. We've seen versions of this before, but over long horizons, systems that prioritize survival tend to reassert themselves. Capitalism itself evolved to reward endurance. Prediction alone has never been sufficient. The deeper implication is philosophical. Buffett's model suggests that the most rational response to uncertainty is not better forecasts, but better design. Structures that forgive error, incentives that align over time, capital that isn't forced to move when it shouldn't. This isn't anti-innovation, it's anti-fragility theater. And as markets grow more complex, that distinction matters more, not less. Here's the unresolved tension. The world is accelerating. Technology compresses cycles. Capital moves at unprecedented speed. Everything feels like it demands prediction. And yet, the most enduring systems seem designed to avoid it. Buffett's approach isn't scalable in the way technology is. It can't be copy-pasted. It requires restraint in a culture that rewards aggression. So the question isn't whether prediction has value. It clearly does. The question is where you embed it. Do you place it at the center of your system or at the edges? Do you build structures that demand correctness or ones that tolerate being wrong? Because in the long run, uncertainty doesn't disappear, it compounds. And capital systems that mistake confidence for robustness eventually discover the difference, expensively. Buffett never needs to predict the future, not because he sees less, but because he's built something that doesn't require sight to keep moving forward. In a world obsessed with knowing what comes next, that might be the rarest advantage of all.